5 years ago, I made a decision to invest $500 every single month into one fund. Not individual stocks, not cryptocurrency, not actively managed mutual funds. One simple S&P 500 index fund. $500 per month. Never missed a month. Never sold during crashes. Never stopped regardless of what the market was doing. Today, I am going to show you the exact results. The total amount invested, the final portfolio value, the actual return percentage, and what I learned that completely changed how I think about investing. $500 per month is not a small amount for most people. It is also not an unrealistic amount for someone with a full-time job who makes it a priority. The reason I chose this specific amount was simple. It was uncomfortable enough to matter, but not impossible to maintain. If investing feels effortless, you are probably not investing enough to change your life. If it feels impossible, you will quit before compounding has time to work. 500 per month lives right in that zone where it requires discipline but remains achievable. In this video, I am going to show you every number. Month by month portfolio growth. The 2 times the market crashed during these 5 years and what happened. The single biggest mistake I almost made that would have cost me tens of thousands. And the one psychological shift that made continuing to invest during the worst market days not just possible, but genuinely easy. Before the results, let me explain why I chose the S&P 500 index specifically. The S&P 500 is not a stock. It is a collection of the 500 largest publicly traded companies in America. When you buy an S&P 500 index fund, you are buying a tiny piece of Apple, Microsoft, Amazon, Google, Berkshire Hathaway, and 495 other companies in a single purchase. This matters for 3 reasons. First, instant diversification. If any single company fails, it barely moves your portfolio because you own 499 others. Second, automatic adjustment. As companies grow and shrink, the index automatically replaces underperformers with better performers. You never need to pick stocks. Third, historically, the S&P 500 has returned an average of approximately 10% per year over the past century. Not every year. Some years, negative 40%. Some years, positive 30%. But the 100-year average holds at 10%. Let me start with year 1. $500 per month for 12 months. Total invested in year 1, $6,000 from my own contribution. Portfolio value at the end of year 1, $6,487. Gain of $487. That is an 8.1% return for the year. Honestly, underwhelming at first glance. I had put in $6,000 and gained less than $500. But here is what I learned in year 1 that changed everything. The purpose of year 1 was not to get rich. It was to build the habit, to prove to myself I could maintain the commitment, to experience a few market drops without panicking and selling. Year 1 is infrastructure year. You are not building wealth yet. You are building the system that will build wealth. Years 2 and 3 together, because this is when the first major event happened. I continued investing $500 per month through all of year 2. By the end of year 2, total invested was $12,000. Portfolio value, $13,211. Gain so far, $1,211. Feeling good. Then, in the middle of year 3, March 2020, COVID pandemic. The market crashes by 34% in 5 weeks. My portfolio, which had been at $15,000 in February, dropped to $10,800 in March. $4,200 vanished in 5 weeks. This was the first real test. Every instinct screams sell before it gets worse. Every news headline says the world is ending. I did not sell. I kept investing $500 per month, buying shares at drastically lower prices than I had been paying in February. Here is what happened next. From April 2020 through December 2020, 9 months after the crash, the market recovered everything it lost and then some. The shares I bought at panic prices in March, April, and May became the highest returning purchases of the entire 5 years. By the end of year 3, total invested $18,000. Portfolio value $24,109. Gain so far $6,109. A third of my total gain came from the shares I bought during the scariest 5 weeks of the entire journey. This taught me the single most important lesson in investing. Market crashes are not the enemy of wealth building. They are the opportunity. When you invest a fixed amount monthly, you buy more shares when prices are low. The crash gave me a permanent discount on future wealth. The investors who sold in March and stayed out missed the entire recovery. The investors who kept buying became significantly wealthier from the crash than they would have without it. Year 4 and 5 felt completely different from the first 3 years. The compounding was now visible. Even though I was still investing the same $500 per month, the returns were growing on a much larger base. Year 4, total invested $24,000. Portfolio value $33,872. Gain so far $9,872. Year 5, total invested $30,000. Portfolio value at the end of 5 years $41,323. Total gain after 5 years $11,323. That is a 37.7% total return on my invested capital over 5 years. Annualized, that is approximately 6.6% per year. Not the 10% historical average, because my 5-year period included a major crash and slower recovery period. But 37% total return in 5 years on an investment requiring zero stock picking, zero market timing, zero active management, just $500 per month, and the discipline to never stop. Now let me tell you about the mistake I almost made that would have cost me everything. Month 18, January 2020. The market had been going up consistently for 12 months. My portfolio was at its highest point. I read an article predicting an imminent market crash. The article was convincing, data-driven, written by someone with credentials, and I genuinely considered selling everything to protect my gains and planning to buy back in after the crash. I spent 3 days thinking about this. Then I asked myself one question that saved me. If I sell now, when do I buy back in? How will I know the crash has bottomed? What if I am wrong and it keeps going up? I realized I had no answer. Market timing requires being right twice. Right about when to sell and right about when to buy back. The odds of being right both times are vanishingly small. So, I did nothing. 2 months later, COVID crashed the market exactly as the article predicted. But because I stayed invested and kept buying, I profited from the crash instead of sitting on the sidelines in cash missing the recovery. The mistake I almost made was thinking I was smart enough to time the market. Here's the psychological shift that made all of this possible. I stopped thinking about my portfolio as money I owned and started thinking about it as shares I was accumulating. When you focus on the dollar value of your portfolio, every drop feels like a loss. When you focus on the number of shares you own, every market drop means you buy more shares for the same $500. Psychologically, this is completely different. In February 2020, $500 bought me approximately 1.4 shares. In March 2020, $500 bought me 2.1 shares. Same $500, 50% more shares. The crash was not destroying my wealth. It was giving me a permanent discount on future wealth. This reframe, from dollars owned to shares accumulated, made me genuinely excited about market drops instead of terrified by them. And that shift is the difference between an investor who builds wealth and one who panics and sells. The most common objection is, 5 years sounds like forever. I do not want to wait 5 years to see results, and I understand that feeling. But consider this, 5 years from today will arrive whether you invest or not. The only question is whether you arrive at that day with $41,000 you did not have or with nothing. And here's the reality. The first 5 years are the hardest. After 5 years, the compounding accelerates. Years 6 through 10 produce more wealth than years 1 through 5. Years 11 through 15 produce more than years 6 through 10. The curve is exponential. The investors who quit in year 3 because it feels slow miss years 4, 5, 6, and beyond when the real acceleration happens. 5 years is not too long. It is barely the beginning. Here is your action from this video. If you do not have an investment account, open one this week. Fidelity, Charles Schwab, Vanguard, all free. Choose an S&P 500 index fund, VOO, FCROX, or VFIAX. Set up automatic monthly investing for whatever amount you can genuinely maintain. Even if it is $50, even if it is $100. The amount matters less than the consistency and the commitment to never stop, regardless of what the market does. 5 years from now, you'll either have a portfolio or regrets. Start this week. Comment below what amount you are committing to invest per month starting now. Accountability starts here.